You might find this interesting. I put a note up about us being long on natural gas, and I got a comment or a question from someone on X and from Celtic Pug saying, not sure, talking about long natural gas. Fundamentals for natty are so weak right now. Huge reserves in storage, record-breaking production, and weather looking warm till mid-December. We're running out of winter soon with gas everywhere, gas everywhere. But hey, what do I know? So this is a question. How do the fundamentals affect the price of natural gas? And you could ask the same question about other commodities. I'm going to give you a very short answer, in that is fundamentals are quite useful, but they're not always reliable, and it's the same with technical analysis. I posted this up in reply on X. The fundamentals. How did it go for wheat bulls after Ukraine, or oil bulls after Hamas Israel, or Nvidia and Apple bears when the US and China got weird with each other? The point is that fundies are useful, but flawed. And the same goes for technical analysis, which is just off the screen. I want to show you a couple of things on the commodities charts here. First of all, natural gas. We've got a technical signal to buy. The poster was saying, well, why are we buying when all the storage is full, we've got production over, everything's a bit overcooked, there's just too much gas around, and the price should actually go down. We've got a technical signal to buy here. It's possibly not the best technical signal, but it's a decent one. And the fact is that the charts are telling us that we could find support here at 285, whereas the fundamentals are saying, well, perhaps we should be looking to short this because there's too much gas around. Bear in mind, we've also got the Israel-Hamas situation affecting gas, not only oil, but gas. Whilst we're talking about Israel and Hamas, you might remember a little while back we went short on WTI when it was right at the top here in the 90s, and we got out right down here near the bottom after having sold twice, one up in the 93 region, once up in the high 80s, and then we bought on this dip. We have now closed that trade in a profit as well. The point here is everyone is expecting oil and gas and anything to do with the Middle East and the potential for expansion of this war between Hamas and Israel to other countries in that region, Lebanon, for example, or even Iran. But instead of the price of oil going up, WTI and Brent crude, the prices actually came down, and fairly significantly. We saw the same thing on wheat. When Russia invaded Ukraine, we expect that we'd see some disruption in the supply of wheat, and that would put pressure on wheat prices. And in fact, what happened was the price of wheat has only dropped. So we've seen it in wheat and we've seen it in oil, both commodities which should have risen but didn't rise and actually fell. Didn't go sideways, actually fell. So there are two really good examples, and you could put natural gas in with that too, where the fundamentals don't actually fit the technicals and what is actually really happening on the charts. That's why, given everything that's available, all the knowledge, all the information, all the stuff that you can get, all the tools that you can find, I still prefer simple technical analysis as the best chance you have of getting the best probability trades. I'm not even going to bring up the Apple and Nvidia conundrums, with those prices having rallied dramatically. Apple about 22%, Nvidia close to 30%, despite the problems between China and America regarding chips and Apple iPhones. Another really good example of markets going one way when fundamentally one could argue they should have actually gone the other way. In the light of this discussion, I want to look at sugar too. Now, we're short on sugar. I'm convinced that we've got a topping formation taking place on the sugar charts right now. It is taking its time, granted, but if we go across to barchart.com, and despite this headline saying there's a weakness in sugar price because of the slippage in the Brazilian real, all the other comments and headlines in here are very supportive of the sugar price. I'm not going to go through the details right now, but there's flooding in the sugar beet fields in Europe, in France particularly. Actually, as a child, I lived in France near Waterloo, near one of those sugar beet farms, so I know exactly what they look like. And then there are more comments about congestion in Brazil's ports, reduced sugar exports from Thailand due to food security issues they're talking about there. And then we've got reduced supply in India due to poor monsoon rains and so on. And there are quite a lot of other factors in there. But when you look at the sugar chart, it looks far from bullish. You might say, well, look how high the price is. Yes, it's incredibly high, but we're forming a very beautiful topping pattern here, and I expect that this price will move down quite sharply. So we're seeing a lot of bullish influences currently on the price, very supportive of the sugar price, but I think this is heading down. So we've seen this divergence between the fundamentals and what we're actually seeing in terms of price action, not only on oil and gas and sugar and Apple iPhones, for example, and perhaps Nvidia chips, but we've seen it on wheat and WTI, Brent crude oil. And you can actually analyze any sort of commodity that you want to, and you'll find out that there are often these weird occurrences where the fundamentals just don't seem to be in line with the prices of those commodities. That's what makes commodities trading so exciting and so much fun, and it's a constant challenge to figure out what's going on between the price action, the chart levels, the price, etc., technical patterns on the chart, and what the fundamentals might be saying. Sometimes they're in complete divergence to each other. Well, I hope you enjoyed that. If you did, please give the video a thumbs up and consider subscribing to this channel. I'll see you in the next video.